Typical way that a business owner will receive money from their business or make a cash draw is they'll just write a cheque from the business account or make a payment from the business account, because cheques don't really exist anymore, and for whatever expenses that they have private, and then come to us later to deal with it. Now, this is not obviously the optimal way to do it. There's plenty of ways that are more efficient and give you more certainty. So obviously budgeting is a big part of this. You need to budget to know exactly how much you can draw, so you're not going to be falling into problems during the year or at the end of the year when you come to do your annual compliance. Because if you draw more than you're able to take, or you put yourself outside of what you consider to be the optimal tax rate, you're going to have things like direct loan accounts to deal with, which require legal documentation to set up Division 7A, which is part of the Tax Act that says you can't take a company's money without paying it as a director. But the typical ways is they'll pay themselves a salary, whether that be market or below market, to give them some certainty around the amount of money they're taking. And then other than that, there could be a dividend policy at regular intervals where the directors and the shareholders will take a regular dividend to fund their lifestyle. Or it could be a policy of on top of the salary they draw an additional amount, and that is then made compliant by a dividend at year end based on the amount that they've drawn out, if they're uncertain of the amount they're going to draw out during the year.